Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as advice at all. It's just general in nature only. We've been given a playbook, and I really think this week it's going to be much quieter than last week, clearly, that we need to have a look at the playbook that the Fed has now given us. And I think that is the honest answer. Before I go any further, I also want to say congratulations to Jay Powell, because unlike his previous two predecessors, he's managed to control the market. He's managed to stop having a tantrum from a fallout with regards to talking about tapering and even actually talking about liftoff, which is quite an amazing thing. But we need to look at those two things separately, because he clearly, and the board also, has them viewed in a separate way. What we know from the playbook now is that the Fed will, as confidently as they're ever going to tell us with the ambiguity language they use, they're going to start in November. They are going to start tapering at 120 billion US dollars a month. They are going to have to start in November, because he clearly states that they expect it to be finished by sometime mid next year. So looking at that and thinking about it, the expectation on the consensus is that it will probably move at about $15 billion a month starting in the midpoint. It'll be 10 billion of treasuries and 5 billion of mortgage-backed securities. So if you start in November and work that through, going at 15 bill a month, you should be done by mid-June next year, which is what he has been alluding to. The other thing that he really highlighted in his speech is that the hurdles for the sustainability of further requirements test has probably already been met. So even if September has a slightly weaker than expected non-farm payrolls, it's not going to sway them either way. I think they've already said that they're there. That's been met now. The legitimacy to actually do some form of tapering has been met, and we're going to go with it. That is a strong thing. You can see that in terms of what happened in Dixie, but it also shows you very clearly that the Fed now has a very, very significant path to what they need to do, because he then went on and separated liftoff. And let's talk about liftoff, because that's the next part of this. Liftoff, although 9 out of 18 members now believe that rates could rise in 2022, liftoff has a significantly higher hurdle in their words. And that means that full employment is a big, big part of this. And Powell, again, part of his playbook was that Delta is in the way. That ability to actually see confidence in the hiring market has not been there. I loved his story that he compared the fact that at the moment they've got a conundrum that normally doesn't happen in economics, which is that they've got about 11 million job ads out in the US, but they have a job shortage. And his allusion to that is that things like childcare and things like daycare plus schools are still being shut down, and they're not at full capacity. And therefore that parent that probably would have picked up a job is still staying out of the market because they can't afford not to be home to look after their kids. That's actually a metric that has now given us as traders a look, because what you want to now see is that as we start to see that switch, that we start to see the amount of job ads being met by the amount of applications, that the amount of benefits that are being used coming off, that sort of correlation, that inverse correlation between benefits and therefore employment is actually a signal to possibly talk about liftoff. But listening again to what Powell is saying, the caveat is there, that if they need to go harder or softer, they will, and that the hurdle for rates is higher out. The consensus at the moment is that Powell himself is probably one of those that believes that rates will rise in the second quarter of 2023. And from my perspective, that matters. He really is the one that really pulls the whole boat. There is only 8 of them that actually end up voting on moving rates. And the majority of those, Lael Brainard, for example, even Richard Carita, they are probably more neutral to dovish rather than things like Jamie Bullard, also Robert Kaplan, these kinds of people which are really hawkish. They're not necessarily in that voting group. One of them will be next year, but that's not a real mover of the whole thing. So the playbook is there. We now know that we are going to get taper. We know that liftoff is probably still a little bit away. And therefore, if you look at it from that perspective, real yields are probably going to start rising. And when you start having a rising real yield, there's 2 pairs to really look at: dollar yen and euro dollar. Dollar yen, the reason for it, the yen is a fantastic sort of clearest play of seeing real yields rising in the States. And every time that we see that, you normally see around about 1 to 1.1% fall in the yen. And that's why that look is probably there. There is a suggestion from the consensus that looking for about 112.5 is where it's going to go over the next sort of period as we get through this moving up in real yields. Euro dollar is the other side of this, and euro dollar, you're probably, again, you're paying differentials here between real yields. It's likely, considering that the ECB is not, in their words, tapering, they're just reconfiguring their quantitative easing programs, that therefore is a dovish sentiment. It's going to put downward pressure on real yields. And then you've got the Fed the other way. So you can therefore make a fairly reasonable argument that short euro dollar is probably also the thing to watch, playing that differential. And they're the two that I'd probably be quite confident with what happens over the next period. And by the next period, I really do mean only looking inside the next sort of couple of months to is no more than June next year. Because past that, we don't know what's going to happen.